A lot of people still believe investing is just for the rich, like some exclusive Wall Street club. That's one of the biggest lies keeping people from building real wealth. The truth: it's never been easier to start investing. With modern brokerage apps, you can begin with as little as $50. That's less than what many people spend on takeout or streaming subscriptions. The real issue isn't a lack of money, it's a lack of knowledge. Another dangerous myth is that you need a massive amount of money to see results. What truly matters is consistency and time. Imagine someone investing just $200 a month in high-dividend index funds. In 20 years, with compounding, that could turn into over $150,000. Meanwhile, those who wait for a perfect amount to start end up wasting precious time. The key is to take action now, because time is more powerful than any amount of money. And that brings us to the next point. Imagine waking up in the morning, checking your investment app, and realizing your money made more money while you slept. That's not fiction. It's the reality of those who build passive income through index funds. These funds allow you to own shares in hundreds of companies at once without picking individual stocks. They pay dividends regularly, and if reinvested, they create a snowball effect. Best of all, you don't need to be a financial expert or spend hours analyzing charts. You just need to choose a solid fund and let time do the heavy lifting. Now, let's talk numbers. If someone invests $2,000 in an index fund with a 2.5% annual dividend yield, they'll start receiving small automatic payments. It might not seem like much at first, but with regular contributions and reinvestment, the returns compound exponentially. Over time, that income stream can cover expenses and even luxuries. The key here is patience and consistency. But let's be real, not all index funds are created equal. And that leads us to a serious problem most people overlook. Many people think investing in the S&P 500 is the ultimate wealth-building strategy. And yes, it has an impressive track record, but when it comes to generating passive income, it can actually be a major obstacle. Why? Because the S&P 500's dividend yield is incredibly low, averaging around 1.2% per year. That means anyone hoping to live off dividends alone will need an enormous upfront investment. In other words, most people quickly realize this approach is much slower than they expected. For example, let's say you want to earn $5,000 a month purely from S&P 500 dividends. With a 1.2% average yield, you'd need to invest around $5 million. That's completely unrealistic for most people. The problem isn't the fund itself, it's great for long-term growth, but it's simply the wrong strategy for those looking to generate income now. So, is there a smarter way to reach that $5,000 a month goal without needing millions? Now that we understand the challenges of traditional index funds, let's get straight to the point. How do you actually reach $5,000 per month in passive income? The answer lies in dividends and yield rates. To hit that goal, you need to calculate how much capital to invest and what return rate to aim for. If you invest in funds with a 5% yield, you'd need around $1.2 million. But if you go for funds paying 7%, that number drops to about $860,000. In short, choosing the right assets can drastically shorten your financial journey. But hold on, you don't have to start with a fortune. The power of compounding makes all the difference. If someone invests $2,000 a month into funds yielding 5% and reinvests the dividends, they can reach that goal in less than 20 years. And if they add extra contributions, the timeline shrinks even further. The key isn't just how much you invest, but where you invest. And that brings us to another critical factor: dividend yield rates. If you've ever looked into dividends, you probably noticed the S&P 500 isn't exactly a cash flow machine. Its average yield is around 1.2% per year, which is great for long-term growth but terrible for passive income. To put that into perspective, an investor would need $5 million invested in the S&P 500 just to generate $5,000 per month in dividends. That's a huge barrier for most people. The solution: looking for funds that offer higher yields without sacrificing stability. There are ETFs and REITs that pay between 4% and 6%, significantly lowering the amount of capital needed to generate passive income. The trick is balancing reliability with higher returns. Chasing only high yields can be risky because those investments often sacrifice long-term growth. So, what are the best funds for building passive income the smart way? Here's the real secret to wealth: compounding growth. While most people focus on how much they can invest today, smart investors understand that time is their greatest ally. Reinvesting dividends means you're not just receiving cash, you're using that cash to buy more assets, which in turn generate even more dividends. Over time, this creates a snowball effect where even small initial investments can turn into massive fortunes. Let's break it down with a real-world example. If someone invests $10,000 in an index fund with a 5% annual yield and reinvests every dividend, in 30 years that amount can grow to over $45,000 without adding a single extra dollar. Now, if they consistently invest more, the gains skyrocket. That's why starting early is such a huge advantage. But there's one key mistake that can hold back this growth: relying on just one type of fund. So, how do we diversify without hurting returns? Many beginner investors assume that putting money into the S&P 500 and waiting for dividends is all they need to do. But here's the issue: this index was designed for growth, not for generating income. With an average yield of just 1.2%, it's one of the worst choices for someone looking to live off dividends. Imagine having $1 million invested. It would only generate $12,000 per year, barely enough to cover basic expenses. Depending only on this fund could be a costly mistake. So, what's the alternative? Combining the S&P 500 with other funds that offer higher dividend payouts. REITs, high-dividend ETFs, and infrastructure funds can pay 4% or more, creating a much more stable and predictable income stream. An investor who mixes these assets can build a strong cash flow without having to sell shares when the market drops. But the real question is, which funds actually make sense for long-term passive income? If relying on the S&P 500 alone isn't a good idea, how can you fast-track your way to $5,000 per month? The answer lies in choosing the right assets. High-dividend index funds, REITs, and covered call ETFs are powerful tools because they offer yields of 4% to 6% per year. That means instead of needing $5 million, an investor can hit the same goal with $800,000 to $1.2 million. A huge difference, with relatively low risk. Another game-changing strategy is taking advantage of compound interest. Reinvesting dividends can shave off 10 years or more from your financial independence timeline. Someone investing $2,000 per month into 5% dividend funds and reinvesting everything could reach full financial freedom much faster. The real trick is finding the best funds that provide both high dividends and long-term security. So, which funds offer the perfect mix of safety and returns? If the goal is to build passive income faster, high-dividend index funds are a must-have. Unlike the S&P 500, which yields just 1.2%, there are ETFs that pay 4%, 5%, or even more. Two great examples are VYM, Vanguard High Dividend Yield, and SCHD, Schwab US Dividend Equity ETF. These funds not only pay strong dividends, but also provide steady price growth, making them ideal for long-term investing. Now, balance is key. Some funds pay extremely high dividends, but they often aren't sustainable. REITs like Realty Income, offer a strong combination of stability and monthly payments. The real trick is mixing different types of funds to diversify income streams without sacrificing growth. But how exactly should you structure your portfolio for maximum efficiency? Creating a strong passive income portfolio isn't just about picking high-yield funds, it's about balancing growth, stability, and cash flow. A well-structured portfolio should include a mix of dividend-focused ETFs, REITs, and infrastructure funds. For example, an investor could divide their investments among VYM, 35%, for stable dividends, SCHD, 25%, for balanced growth, VNQ, 20%, for real estate exposure, JEPI, 15%, for high monthly payouts, and VIG, 5%, for long-term appreciation. This strategy ensures consistent income, while still allowing for capital growth. A fund like SCHD provides both dividend payments and strong appreciation, while VNQ gives exposure to the real estate market. Diversification means the portfolio isn't fully dependent on one asset class, reducing risk in case of market downturns. But the real magic happens when you reinvest dividends and let compound interest take over. So, how much impact does that actually have? Now that we know why diversification is important, let's build a real-world portfolio that generates reliable passive income. Imagine an investor starting with $50,000 and spreading it across 5 strategic funds: VYM, 35%, SCHD 25%, VNQ 20%, JEPI 15%, and VIG 5%. This mix ensures consistent dividend payouts while still allowing for long-term capital growth. With this portfolio, a 4.5% average dividend yield would generate $2,250 per year in passive income in the first year alone. Reinvesting those dividends and adding regular contributions can accelerate the income exponentially. The key benefit: this strategy doesn't rely on just one type of asset, keeping it stable even during market downturns. But the real game changer is the power of compounding growth over time. If there's one financial superpower most people overlook, it's dividend reinvestment. Instead of spending dividend payments, smart investors use them to buy more shares, which in turn generate even more dividends. Over time, this creates an exponential growth effect. A $100,000 portfolio yielding 4.5% could grow into over $500,000 in 25 years, without adding extra money. That's the difference between just collecting dividends and building true wealth. To maximize this effect, it's important to choose funds with a history of dividend growth. SCHD, for example, has grown its dividends by over 10% annually. That means even if the market stays flat, your passive income still increases every year. This small detail can turn thousands into millions over time. But how does this compare to other investing strategies? Not all investment strategies are created equal. Some people rely on S&P 500 index funds, while others chase high-yield dividend stocks. But what's the best approach? The problem with only investing in the S&P 500 is that it generates very little income. On the other hand, picking individual dividend stocks can lead to high returns, but it requires a lot of research and monitoring. High dividend index funds offer a balanced solution, combining diversification, steady income, and growth. Another debated strategy is REIT investing, which can pay over 5% in dividends. However, REITs can be volatile during market downturns. Meanwhile, ETFs like JEPI and QYLD pay even higher dividends, but their long-term growth is limited. The right choice depends on your financial goals, maximizing future gains or ensuring a stable, passive income today. But is there a way to achieve both growth and stability in the same portfolio? One thing that separates successful investors from amateurs is diversification. Putting everything into one type of asset might seem tempting, but it's a huge mistake that can cost you in the long run. A balanced portfolio should include index funds, REITs, high dividend stocks, and even bonds, ensuring stability while allowing for long-term growth. For example, while an ETF like SCHD offers moderate growth and strong dividends, a REIT like Realty Income, O, provides monthly payouts, helping investors cover expenses without selling assets. The key is strategic allocation. Some sectors, like technology and energy, are more sensitive to market cycles, while others, like healthcare and infrastructure, tend to remain stable. A well-balanced investor doesn't rely only on dividends or stock price growth, but instead combines both for long-term success. But how does this kind of portfolio actually grow over time? A well-structured portfolio not only generates passive income but also grows significantly over time. Let's say an investor starts with $50,000 in high-dividend ETFs with an average 4.5% yield. If they reinvest dividends and contribute $500 per month, their portfolio could exceed $500,000 in 20 years, without needing to pick individual stocks or time the market. This happens because compound interest works like a financial accelerator, making every reinvestment increase future earnings. Now, what happens if they increase contributions whenever they get a raise or bonus? Even an extra $2,000 per year could push that portfolio past $1 million much faster. The mistake most people make is only thinking short-term, not realizing that small decisions today create massive results later. But what if there was an even faster way to grow your investments? Most people underestimate how much small increases in investments accelerate financial independence. Let's say someone is already investing $500 per month into dividend ETFs but decides to increase it by just $100 per year. Sounds small, right? But this tiny adjustment could shave off 5 years from their financial freedom timeline. That's because every extra dollar compounds, turning a slow journey into an exponential wealth-building strategy. Now, imagine applying an even more aggressive approach. Instead of spending bonuses, tax refunds, or unexpected income, A disciplined investor redirects that money straight into their portfolio. While most people use that cash for things they don't need, smart investors turn it into passive income machines. The reality is, you don't need 40 years to live off dividends, but to get there even faster, you need a clear strategy. So, what's the most efficient way to reach $5,000 per month in passive income? Reaching $5,000 per month in passive income isn't about luck, it's about strategy. The fastest way to get there is to build a diversified portfolio that includes high-yield index funds, REITs, and covered call ETFs. Investors who stay consistent, reinvest dividends, and gradually increase contributions can cut decades off their financial independence journey. The key is not waiting for the perfect moment, but instead starting now with a solid plan. Also, choosing the right funds is a game changer. ETFs like SCHD, VYM, and VNQ provide a powerful combination of growth and stable dividends. By combining these assets and staying focused on long-term results, anyone can build a reliable income stream without needing millions up front. But here's what most people don't realize. What's the absolute minimum you actually need to start this journey? Now that you know exactly how to build passive income with index funds, the real question is, are you going to take action or keep letting time slip away? The difference between people who achieve financial freedom and those who work forever isn't luck, it's the choices they make today. Every dollar invested today is a soldier working for your future, and the sooner you start, the less effort it takes over time. So what's stopping you from taking that first step? You now know you don't need millions to get started, just a plan and some consistency. If this makes sense to you, subscribe to the channel, turn on notifications, and keep learning more strategies to accelerate your financial independence. Your future starts now, and the best time to act is today.